Righto, money miners. Part 2 of our Livewire chat that you might have seen going up the other day on the Livewire platform with Fisty from Firetrail and Darko from Janus Henderson. Come in to talk some stocks.
It was awesome. It was awesome. I don't even think you need to listen to it necessarily in order. So if you just tune into this, listen to this, and if you're like, fuck, I want more, just go to Livewire's channel and you'll find it there. It was just a riveting convo to listen to. I didn't participate like you two great blokes did, but I loved it.
Put his hand up and just willingly, you might have had COVID at the time, but anyway. But no, it's
and
good.
You forgot James Marley from Livewire.
James Marley,
the big man.
Mr. Livewire himself.
You haven't taken that hat off since getting it from him.
It's the fucking best hat ever. I love it. I hate wearing my own hat because I just look like a promotional dickhead. So,
Matty, what did we talk about in part 2, mate?
Mate, you got onto your topic that you have to weave into every episode, Robert Friedland. You love Robert.
I don't mind a bit
of a man crush.
It's more the African copper, but, you know, Friedland is inextricably tied in at the moment.
Yeah, we went into a lot of gold between Spartan, Bellevue, Genesis, and when we talked about the gold, stay tuned, money miners, because there was some comments from the boys regarding funding that probably are very different to what we talk about other time, and it was a bloody good part of the convo. Hang on to your seats.
He had a punchy comment as well comparing Bellevue and Never Never, Spartan, so hang on for that one. And, Matty, the topic so dear to your heart, uranium.
Uranium. Ding, ding, ding. I hold uranium stuff. No, let's bloody... And, mate, as we've said before, can't thank bloody James and the Livewire team enough for having us. And I thought one of the best things was like we were doing our style. James rips over, starts talking about the products and the investment style. And it was just in Money of Mine and Livewire in unison. And it was great to be around them.
It's awesome. It was really awesome.
Righto, let's get into it with Darko and Fisty. Here we go.
Darko, how about Ivanhoe mines? I want to talk about them because we don't talk about Friedland enough on the show for the sort of...
He talks about himself enough.
for the character he is in the industry, probably given that they're just not listed down here. But how do you see the opportunity for growth at KK and everything that's going on in, you know, that part of the world?
Well, look, first of all, you know, with Robert Friedland is a force of nature, you know, and he's repeated this a number of times, so it's not luck. You know, he's one of these guys that backs people with skill, technology, and spends the dollars. And the results are obviously there, whether it's Oyu Tolgoi, whether it's obviously Kamoa-Kakula. If you look at Kamoa-Kakula, it is, I mean, you don't want to talk about too much T1, whatever, but look, it's a monster deposit. It's probably the biggest copper discovery in 30 years globally, right? It just happens to be in the DRC, a country that a lot of people don't like or they don't understand, but they built a monster mine, currently ramping up to 400,000 tonnes of copper, so it's well in the top 10. It's already got a next phase of development to take it to about 600,000 tonnes, and then it's got the potential to go to 1 million tonnes given the resource size. So this will be a top 5 mine on its own. And it's world class in terms of grade. I mean, for the first...
Phenomenal.
I think in their studies for the first 10 years, grade's 5-6% copper, which is like 5 times, 7 times the average grade of a copper mine. On top of that, you know, it's a shallow mine. The style of geology, sedimentary hosted, it's shallow, so it's cheap mining, bulk mining, massive plant operations. To create more value, they built a smelter because one of the challenges in DRC is logistics, you know, getting stuff out of DRC to the various coastlines. So now there's a railway line that's built there was one from Lobito in Angola all the way to now Kolwezi. So what they've done is phenomenal. You know, they've built something on time, generally on budget, and ramp up has been superb. And they've done it in the country that people see as difficult. But the other thing they have is and we talk about carbon footprint and everything, which is becoming a big question for people. It's got one of the lowest carbon footprints in the world because, one, it's an underground mine, and two, it's got access to massive hydropower generating capacity in the DRC. It's huge. So you combine all of that, it's a ridiculous thing. Now, in terms of value, stock's done really well, like every copper stock. You know, you always kind of look. We've been in the name for 4 years, 5 years. we're still there. You know, we might trim here, there, you know, whatever. But it's one of those names that just will keep on delivering. Is it M&A target? Who cares? Because it doesn't matter. You know, M&A's cream on the cake. The cake is Coca-Cola.
Yeah, your
Monster.
point on the carbon footprint is fascinating. I was listening to the recent call, and you know there won't be a call that Friedland won't let you know about the low environmental footprint.
Of course. Yeah.
And he said 100% there'll be 2 tiers of pricing for copper. What do you think of that?
Look, I'm not an expert on commodity trading. I know there's a lot of work being done on, you know, monitoring carbon credits, you know, levies, taxes, God knows what else. I haven't yet seen anyone pay a premium for green. Whilst people talk about the concept and the possibility, yet to see it. So that's all I can say. It's too funky for me anyway, so I'm just a simple, you know, stock guy.
Yeah, I don't want to pay for it because we're the ones that are paying for it.
Look, having said that, you know, the direction of travel is that way. You know, if you listen to customers, global customers, all of them are driven by these variables. So, you know, it might come, but I don't know how it will be, you know, affected.
Darko and Matt, I want to talk to you a little bit about the strategies that you run. At Janus, you've got the ability to go global and ride up the market cap, and it's a pure resources play fund. And Matt, you run the commodities sleeve of a small cap fund that's bundled in there with industrials, all sorts of other things. What's the difference between putting together a portfolio, Darko? Do you think of 100% commodities companies? Like, you know, Matt's talked about the fact that he likes small companies, this, that, the other. Do you have to offset what you're doing? Does that factor in? Do you need to put some ballast in with some majors and that sort of stuff? How does the composition of the portfolio change when it's pure commodities?
I've been in different roles over the years. I think if you're working in a broad strategy, you're competing with other things, right? So you're competing against technology, financials, all the other stuff that you can invest in, and resources is just one pool. For us, you know, we talk to various people within our company, and someone says, you know, what's your view? And we say, well, guess what? We're bullish because we're a resource fund. Jokes aside, of course we're going to have a different view in the way we structure our portfolios. We run a very diversified strategy: mining, energy and agriculture, equity only, long only, global, so we could be anywhere. We do have a benchmark that we're kind of aware, but we swing around that. And it tends to be mid to large cap, but we also have this pool of small cap. Look, for us, the challenge isn't that we don't like everything, so we'll go to cash. You can't do that, so you have to be invested. So the challenge for us is to figure out where each of those subsectors is in terms of upcycle, down cycle, valuation, relative value, you know, defensive or offensive. So, for example, you know, at the moment, you know, probably and you guys probably have been talking about it now for a while. You know, what are the 3 things that? Well, I name 3 because it's the 3. Uranium, gold and copper are the things that are really moving. Everything else is kind of going nowhere, flat or whatever, or down. So the challenge for us is, you know, to hopefully be right when things are moving up and allocate capital to that. But when things start to wear off, you know, from a valuation or whatever it may be, we put more money into defensive. So it could be oil and gas, for example, that's defensive. In fact, today, they are defensive because they're actually much cheaper than everything else. So it's about reallocating, you know, investments and repositioning, whether we're in the up cycle, down cycle, valuation. But by definition, we're always there. We're captured to the thematic.
Yep. And what about market cap? Like, if you had a skew or a preference or where you think you can make the most money, is there a lens from a large cap to a mid to a small, or is it just finding a basket of opportunities in those commodities that you've identified as a swing?
Yeah, look, from my perspective, you know, the real alpha generation is from the drill bit, you know, so finding the next thing. Investing in BHP Rio is a good thing, but, you know, you're playing the momentum, the cycle, you know, some relative value, but is BHP going to double? No, unlikely. I mean, it might, but unlikely.
Not in a hurry.
But, you know, if you find Liontown at 50 cents and it goes to $10, that's real alpha, right? And the beauty of the space is that it needs new discoveries and new developments. So that's the great opportunity set to create alpha within the sort of portfolio that we have. That's why we mentioned that we can drift down to that market cap when we're looking for new things. And that's what I love doing. That's kind of what my excitement is. Visiting a coal mine or oil field, yeah, it's interesting. But what I'm interested in is the finding those geologists that are finding the next big deposit.
Darko, you don't even need geos to find these bloody big ore bodies anymore. VRIFY AI does it for you. Boys, bloody, the geos are now productive, like way more productive. They can be doing other shit. They don't have to be finding this stuff.
What was the number we heard? Was it 15x more productive, 20x more productive?
Yeah.
It's kind of like, imagine if you were a mathematician back in the day and then the calculator came out. You could get way more math done.
I think that is a perfect
great analogy.
Metaphor, because like the geos now, they just freaking load up the geochem, the geophys, the historical drill hole assays, and the VRIFY AI does it in less than half an hour. So, mate, they can pretty much by the time they go bloody cook their toasty, talk some shit at the water fountain, it's just boom. There's your exploration target. Go and fucking drill there.
It tells you the relationships, like what are the factors that, what are the relationships we see which might correlate with mineralization or those sorts of things, right? And like those are the intuitive things that, actual geologists can take hold of and be like, this can guide my exploration philosophy going forward.
Oh, mate, when we explained it to Darko, he was just frothing. He's just seeing dollar signs.
Yeah.
And if the VRIFY AI, if that hasn't got you over the line, they've got the perfect product to explain your ore body to the investors. The foundational VRIFY product, forget the PowerPoints, they're done, they're in the bin, you're never going to see them again. Just sign up with VRIFY, they'll run you through how to use it, all the ins and outs of it.
Am I hearing a turnkey solution, JD?
Turnkey solution. That's what we're all about, Matty.
Yeah. Thanks, VRIFY AI and VRIFY. Very fine.
That's really what excitement's about.
What about you, Matt?
Look, I think there's an amazing opportunity in small caps at the moment because you've got, the large caps are, pretty fully priced. We're going through a commodity boom cycle, there's no doubt about that. See it continuing. But then there's a subset of assets that sit below the radar of most fund managers. And these are assets that have been discovered. Yeah, sure, they're not tier one assets, but they're the kind of assets that need to come into production. And we look at the net present values of some of these assets versus what they're worth at today's spot commodity price. And we think there's a wave of M&A that has occurred and is still to continue with producing companies buying development assets to refill their hoppers.
Yep. And where do you start with your process? Like, what's the bottom level cutoff that you have in a small cap fund? Is it a market cap limit? Is it a project ready or a development stage? Like, where does it start to kick off, and where do you start looking to feed your funnel?
Look, there is no cut-off. It comes down to liquidity. If there's a liquidity event and it's compelling enough, we will look at it. The one thing we won't invest in is exploration. Having been an exploration geologist in a prior life, it's too much gambling for me, particularly with other people's money, as well as my own. So we definitely don't invest in pure exploration, but anything above that is fair game.
So what is that like? So when there's a mineral resource estimate that comes on the back of the exploration, is that then it's got your attention?
Yes, but we'll also go pre-mineral resource as well. Yeah, very happy to do that and form a view on the geology, what the size of the resource is going to be, because that's really where we can add alpha to the process that potentially a generalist investor who doesn't have a technical background in resources, potentially they can't do that.
Somewhere between 80 and 100, there might even be more now, but there's a lot of small cap funds out there sniffing around the small cap market for ideas, but a lot of them exclude the resources component. A lot of them go industrials only, too hard to figure out. How competitive is it for you to find ideas? Do you feel like there's more of an alpha opportunity, less of a price discovery moment because you would talk with your peers that do the industrials component, all that sort of stuff? Yeah,
undoubtedly. I mean, the alpha opportunity in resources is enormous, and I just can't understand how you'd run a small cap fund and not invest in resources. Australia's got fantastic geology, we all know that, but we've also got the social and physical infrastructure to extract this stuff out of the ground. And it's one of the only countries in the world where you can still, within a reasonable time frame, with the rule of law, get commodities out of the ground, get them on a boat and make lots of money out of them. They comprise 30% of the small cap index, right? There's
you have to be in it.
You have to be in it, yeah.
And the Aussies love a punt. There's plenty of liquidity drive.
I was going to say, it's fun as well. Yeah, it's an entertaining sector.
Definitely much more fun than Commonwealth Bank.
So Darko, you mentioned the three commodities there. I want to talk about gold now, and I want to start with you, Matt. One of the names you hold is Spartan.
Yep.
You know, they've got an interesting past 5 years. Where do you see the sort of story going from here?
Yeah, we're really excited about Spartan and the drilling results that released yesterday, I think it was. I think confirmed that. When we look at the small cap golds, and we joked on the way in here, I think, Matty, about the lack of free cash flow that's being generated, and that all comes down to grade. So over time, the deposits are getting harder, costs are going up, grades are going down. And so an asset like Spartan, which in our view is likely to have a plus million ounce reserve, with a head grade of 5 to 6 grams per tonne with a mill that's already built, we see that as a fantastic addition to anyone's portfolio in the gold space, likely to be a 10-year asset as well in our view. So from here we see continued resource growth, continued reserve growth, and then really a pathway to what the right sizing of the mill is. The mill's currently got a capacity of about 2.5 million tonnes per annum, as I understand it. Can they find enough of a resource to fill that mill up completely? Do they need to downsize it? I think we'll have the answer to that in 12 months, but yeah, it's going to be exciting.
Interesting thing about them, I think, like if you like compare them to Bellevue, they obviously haven't got the grade of Bellevue. It is a bit thicker, but just, you know, Bellevue's got declines going out that way, that way, that way. The Spartan mine, like that exploration decline they're putting in, it's just goes past each ore body. It looks like it's going to be, if it all proves up, it's going to be probably a lot lower cost and a lot simpler to mine it. And I think that's a big. That can mask a bit of grade, but the grade's good as well. But like Bellevue's obviously a standout in the grade, but having a lot more spread out and a lot harder ground can. That's what we're waiting on to see what the bloody costs are.
Yeah, well, we'll come back in 3 years' time, and I wouldn't be surprised to see Spartan with a higher grade than Bellevue. God,
bloody, that's recorded on play.
The time will tell. But the geometry of the ore body is just so simple, and that, as you know, that creates a lower mining cost, and that's something that when they look at this deposit, most people don't realise. Yes, they say the drill intercepts, but they're not thinking about the geometry of it, what that means for mining costs per tonne, and ultimately what that means for the all-in sustaining cost per ounce for the business. And we reckon that's going to be sub 1,500 for sure.
On the point on capital costs, they did a raise a couple of weeks ago now. Do you think they can debt fund the rest?
If they choose to, absolutely. Yeah, would we encourage them to do that? Probably not. I don't think if you're going into a production as a single asset company, you should be debt funding anything. You should use all equity.
All equity?
Yeah.
Why is that to so you don't not tied to hedging or anything?
Chunk of it.
There's just too much risk. We see it time and time again. I mean, De Grey, perfect example yesterday or the day before, $600 million capital raise. They're going to go out and build that thing. Will that be the last capital raise? If it's not, what price are they going to be raising at? I mean, you need to de-risk these projects in our view, and you know, should there be another single asset gold mining company out there? Well, my personal view is no, but if you are going to do it, we don't need additional leverage through balance sheet. There's enough leverage through the gold price and operations. Use equity and do it properly.
There's too many examples of companies that, you know, everyone wants to limit dilution, so they want to use as much debt as possible. But guess what happens? They end up raising equity at the worst possible time when they transition from development to ramp up. And there's just a litany of those examples, and you see, and a part of that is you then have to hedge to secure that debt. And again, there's been a number of examples where companies have just got out of the money hedges that are just hurting. So a single company with a viable asset, if possible, given your market cap and everything, you should use as much equity as you can.
De-risking 101, boys, is Silverstone powering up mine development. That is, we're talking about funding side here, but tell you what, that Spartan decline that Fisty is a fan of, that better bloody have some Silverstone electricity flooding into those jumbos and fans. That's the kickstart.
What's the difference between a mine powered by Silverstone and one that's not, Matty?
One is good, one is shit.
Yeah.
I think it's like there's just either ends of the scale.
Could you go as far to say as one is profitable, one is not profitable?
Oh, yeah, good, bad, profitable, unprofitable, bloody superior, inferior, like
investable, uninvestable.
Yeah.
What's the worst mineral that you know? Kaolin. There's nothing worse than one's Silverstone, the other one's Kaolin stone.
Polyhalite. Right. Because after Silverstone power this Spartan decline, which better bloody happen, but they'll be putting a solar farm in, no doubt. Silverstone will do that. They'll be putting hybrid power stations in. Some Dalgaranga EV charging stations. Geez, they wouldn't be too bad.
That's the thing, Matty. You scroll through the Silverstone website, you get a feel for the brand, and we're not just talking about diesel generators. Any type of power query you've got, Silverstone will answer it for you.
Mate, the next generation of power transition is coming via Silverstone. And look, Spartan, I've heard on the street, I heard it across the road, the new Spartan motto in terms of whether to fully utilise all the power options available from Silverstone is you never say never. Never.
Well done, Matthew.
But I suppose on the other side, but you look at like a Capricorn, for instance, who, debt funded, executed, and now they're, I guess you'd say the performance per share is you just look at the trading multiple.
That's Capricorn, and there's not many, kind of management.
Unicorn.
Not many management
teams.
0.9
grams
that
to be a
have
unicorn.
historically demonstrated that number of times where they've got this cookie cutter style where they just apply this philosophy, but that doesn't represent the bulk of the junior space. So, and case in point, if you look at De Grey, that's a tier 1 asset. It's going to be there for a number of decades. And whether they raise 600 or 800, actually when you look at the dollar per share value, it's like a few cents one way or the other. And so in fact, the more equity, the less debt, the less risk you have, because there's all the other stuff that happens. One is dollar per share value, but what's the market going to price you at going forward? And the more debt you have, the lower the multiple relative to others because of the perceived risk. So, it's about de-risking not only the technical bits, but it's the balance sheet. More equity where you can. But I know there are instances where that's not possible, and that's why you end up with streams, royalties, and all the rest of it, which complicate the story.
You've got to get the major shareholders over the line, because you look at what Andrew Forrest makes out of Fortescue, because he never raised money. So Bellevue, for instance, trying to convince Steve Parsons to raise like that. They're the big factors that will drive those decisions. I think it's what those major shareholders want to do.
Again, it's if the market's valuing you, there's the adage in our business is you raise the money when you don't need it. So as your stock price is moving up, it doesn't hurt to raise the equity because the market could collapse the next day. At least you got your 30 million to keep going. And I think a lot of companies forget that, and they wait or miss the spot. So it's about how you get re-rated in the market and what you do with it. But not everyone can do that successfully. So, and that's a function probably of the discovery, of the deposit, the underlying thing that the market likes.
Yeah. Fisty, you mentioned Genesis before.
Yep.
They're a bloody interesting one because they've obviously got they've got a bit of a short interest.
Yes.
And it seems like some people might be long Bellevue, short Genesis, but they're a couple of billion at the moment, are they?
That's right.
Yeah, 2 billion for 120,000 ounces. It's all growth. Tower Hill's going to be the big one, but you look at Gwalia and Ulysses as they're going to be the flagship underground operations till Tower Hill comes. But mining 30 to 40 degree dip in ore bodies like Ulysses is 30 degrees. I know it's going to be a bit shallower, so you're going to be a bit easier. But it's like those undergrounds. It's going to be so hard to ever get the costs down on those undergrounds because of depth, because of productivity, increased lateral development for a shallow dip in ore body. But are people investing purely based on that growth profile for Tower Hill?
Yeah, I mean, everyone, I get these emails every single day and they say invest in Ramilius or invest in Silver Lake. It's trading on a 15% free cash flow yield next year. And yes, it may be next year, but what's the free cash flow yield in 3 years' time? What's the discounted cash flow valuation? That's the way we look at the world. Each to their own in terms of how they invest, but that's the way we look at it. And when we look at the future value of those cash flows for Genesis, we see increased production, costs coming down over the long term, and a great growth story that the market, in our view, just does not appreciate. And so whilst, yes, you're correct about the geometry of the ore body, what that means for mining rates, etc., It really is a grade-driven story at Gwalia. I mean, that mill hasn't been full in 10 years. We're yet to see what the cost profile looks like when you've got a couple of different open pits going through there, as well as 2 high-grade underground mines. And I think people will be pleasantly surprised when they see what that means from an all-in sustaining cost basis.
So what do you think is going to drive all that cost down? Like you mentioned, like filling the mill, like the cheaper open pits. What are going to be the main factors for it, you think?
Oh, it's just
the whole thing.
Yeah, it comes. Yeah. It's great, and it's just filling a mill. I mean, it's not rocket science, right? It's just industrial logic of having a fixed cost base. Every single mining asset, as we know, roughly 70-30 fixed variable. You fill up the mill, you produce more ounces, you'll make more cash flow. And Genesis, they have the assets to do that now, so we're really excited to see what they can do. The other lever that we see for significant value creation, well above and beyond what the market currently has in forecasts, is the bring forward of Tower Hill. The equity value, or the implied equity value that Genesis acquired St Barbara for, we believe that was supported just by Tower Hill. Once again, coming down to the grade and the quality of that ore body and the cash flows that it will produce. Yes, people can say, oh, it's 2029, you need to move a railway to get there. To us, that's actually positive. The only reason that ore body still exists, hasn't been mined out years ago, is because there's a railway line on top of it. That just tells you that it's a really high quality ore body that needs work to get to. And so the bringing forward of those ounces into the mine plan for the combined portfolio, we believe will see them significantly outperform.
How do you think about the management premium you see a company like Genesis sort of have? Can you see a point in time if they don't continue to prove to the market that they're worthy of that sort of premium valuation, that it could come back to bite them?
Oh, absolutely. Yeah, the pressure's on. There's no doubt about that. I mean, they've got a great track record to defend, and I'm sure they're very aware of that.
Plus, they have a very supportive shareholder base. You know, the
super fund, Aussie super
large, high quality, deep pocket kind of investor base that will support whatever they need to do. So that helps, together with the growth plan.
As a general, I think management premium is underrated in resources. CEOs that can attract, retain good teams, deliver outcomes, manage the market well, and most importantly, make good capital allocation decisions. I'm willing to pay for that 100%.
Yeah, at a cheaper cost of capital as well.
Absolutely.
Generally.
Yeah.
Uranium's another commodity we've got to talk about. And
how bloody good's uranium? Love it.
Darko, you mentioned you're heading overseas shortly. How do you see the market more broadly to start with, as it's so, thematically driven at the moment?
Well, there's a couple of factors. Obviously, the macro is positive. So probably over the last couple of years, even in Australia, we're starting to think about maybe having the conversation about nuclear power at some point in time. But it's a big thing overseas. That's a build-out that's taking place. You've just had recently COP28. I think 25, 26 countries, including the US, have committed to triple their nuclear fleet by 2050. That's a material change in the market that I don't think anyone's really appreciating, because it's just a bit too far away. But it's a massive demand of uranium. There's just no pipeline of projects to do that. Obviously, the uranium price has done pretty well. It's come back a bit, and now it's kind of moving forward. Look, the uranium price itself is high enough to attract new projects. So the marginal projects, the mines that have been offline, like Kayelekera, Lotus, Langer Heinrich, for Paladin, Honeymoon Well for Boss. It's at $70, $80 a pound. It's well and truly in incentive price. But what happens is when all of those things come back on, and there's a few of those in North America and the US, but they're all ISR, so they're all small, 500,000 to 1.5 million pounds a year small. So when they all come on, you still need more uranium if the market's going to balance sometime going forward. The question really is, does the market slow down a bit? But what we're hearing more is the recontracting phase. Utilities are now starting to recontract again for the long term. Where will they get their supply from in 2028 or 29 or 30? They did that in the last bull cycle. That's all kind of worn off, and now they're doing it again. And that's what's going to drive prices up. Having said that, the equities have done really well. You can't say that they're cheap. You've got companies that are a couple of $1 billion market cap. They're not producing any uranium. They might produce uranium in the future, but I think it's a limited space. There's not a lot of things you can really buy And there's not a lot of, we keep a track of pretty much every uranium project, either if it's just a resource play or a pre-development, and it's probably about 35 names, of which probably you've got to cut out half of them because they're just exploration, maybe with a modest resource, and a long way away from being economic. So the issue for uranium is just the macro is so supportive. But the risk is it's like copper, it's always 3 years out, that this sort of massive deficit. But the construct is very, very positive, and there's a limited way to play it. There's really only 2 producers, there's more now because of just a couple of restart, but Kazatomprom Prime and Cameco are the 2 established producers, and now you've got Boss, Paladin, UEC, Ecor. So there's a few of them, but they're not, there's not a lot of them to play with. So there's a premium attached to these names. So if you look at, say, Cameco, it's trading at probably 3 times the multiple of a BHP or Rio. Why? Because it's just the limited pool of investment. So the construct is good. The other factor that I kind of, in my mind, characterise uranium as a mean reversion story. That is, it was over $100 pre-Fukushima. It collapsed down to 20. It's now back at nearly 100. Game over. Well, is it? Now, when you look at it, will uranium become a demand story? And that's the challenge. And I think if we look at COP28, these SMRs, the small modular reactors that people are talking about, they could be a real demand driver for more uranium. And when it becomes a demand story, then it's a very different dynamic that could really change the picture. If you listen to, say, John Borshoff, the guy that's been around for a long time, he knows the industry in and out. He's quite out there in conference saying, look, it's not inconceivable that uranium could be $250 a pound. Now, am I going to bet on that? No. But if you kind of look at the mechanics, it's not impossible, but you don't bet on that. But so the structure, I think, is very, very positive, but you've got to pinch yourself. Nothing goes up in a straight line, so you just need to kind of monitor and balance that view. But we've got a few positions. We tend to play. We've got Paladin here, and we've got 5, 6 other names globally.
Now you're looking at like your silexes and stuff for enrichment. Like you talk about the SMRs. That means that needs uranium, but needs a shitload more enrichment to actually get it to the
and
HALEU.
That's the big. If we talk about investment in mines, then there needs to be an investment in enrichment, and especially if what's happened with the US and Russia. Basically, the US will stop consuming Russian fuel, uranium as fuel. Well, if you do that, where's it going to come from? Well, that requires new capacity, so that's where a silex will come through it at some point in time.
But Fisty, what the hell are NexGen doing, taking on debt to buy uranium pounds?
Tough one to
Has
defend.
anyone
Tough
got
one to defend. Yep.
Has anyone got an answer?
Look, I think it's a very, very strange move.
It's funky.
Yeah, it's funky. I mean, every dollar they spend buying uranium is another dollar they need to raise to fund the project. And so for something that's probably not coming online until 2029, 2030, I struggle to understand why they've done it. Laying in bed last night, reading my phone, scratching my head, maybe getting a bit angry.
Threw it at the wall.
But strange move.
We got punished for it.
Yeah.
Down 12%, I think.
Oh, really?
Yeah.
Jesus
It's
Christ.
down. I think it was 10% in this market today. Yeah. Look, you scratch your head a little bit. Okay, they bought uranium, but Paladin and Boss bought it at 30 or 40. So now they're buying at 90, and then you think, well, okay, how's that going to work out? That means for you to profit or whatever, you obviously assuming the prices are going to be materially higher. They may or may not be. I think, to me, NexGen is like De Grey. Just raise the capital. You got the market cap. You got a monster deposit. It's a tier 1. I classify some of these things as category killer. When you've got it, you've discovered 300 million pounds plus of very good grade deposit that will become a modest mine in size, producing possibly 20 million pounds. 3 years ago, everyone would have worried, geez, how are you going to place 20 million pounds?
Well, I think it's going to be 30 for
and
the first 7 years.
The other day when I asked management, when we were talking a few months back, the question now isn't how you're going to place it, is how quickly can you come to the market? So, that move was interesting, especially after the equity raise. I just thought that was kind of a bit
within
odd.
days.
A bit odd.
Yeah, I mean, we think NexGen has the world's best undeveloped resource project,
Yeah.
period, in any commodity.
Definitely does.
And yeah, that's the thesis behind our investment. So we're still excited about that. But I mean, if we want to go out and buy uranium pounds with our money, we can do that. Anyone can do that. If you want to invest in the world's best uranium project, you go buy NexGen. So to us, it just doesn't make sense.
I get the part of the logic, which is probably why the others did, is if you're ramping up, there's kind of a period where, you've got offtake contracts that you've got to meet, and, you've got issues of ramp up and producing the pounds and then delivering the pounds. But, the market is quite dynamic. What you could do then is just offset your contracts a little bit later, and if you produce any pounds that are not contracted, you could sell that in the spot market. So there's a lot of things you can do, but
and they do have 6 years to prepare as well.
And I guess they did what they did.
So can they use that inventory as like security for debt or things like that? Is there any advantage there in the future?
I think the logic that the others use is that it's actually their security to off-takers, because the off-takers know there's pounds that they control that they can release into the contract if there's any shortfalls in the production at that point in time when those contracts have to be met. So that's the logic. It kind of makes sense, but...
Yeah, but it makes sense if you have an ISR asset. It's hard to predict how much production you're going to produce, and you might be producing next year. This is a hard rock asset where you can mine however much you want in a given year, and they're not producing until 2029, 2030. So
I guess we're not different. The market spoke and didn't like it.
Yep. That's usually the best indication. Covered most of it, eh? What else have you got?
I think we've covered all of it. Appreciate you guys making the time to
Bloody
chat with us.
Yeah,
James, thanks for taking a gamble on us, and I didn't even swear once. A bad swear.
Or vape.
Well, as I said, we have a bunch of readers and viewers at Livewire that are passionate about resourcing. They'll probably give you guys a run for your money. So I'm really appreciative of you guys coming in, helping out with the questions. The knowledge and the passion was awesome. And Darko and Matt, thank you very much for coming in as well. It's been a pleasure to have you.
Yeah.
Thank you for the invitation.
Cheers, appreciate it.
Righto, bloody good fun. Good to meet the lads too.
That was awesome,
Ex-Geo, ex-Met, and mate, that comment regarding how they perceive funding risk and how they would prefer equity. Not sure all the major shareholders think that of companies, but after hearing it was like, we were so thinking the other way sometimes. But after here, I'm like, well, fuck, it makes fucking good sense to me. Reduce your amount of hedging, bloody limit the risk, and yeah, God, if you get it over the line.
I think I'm going to tease a bit of analysis that I want to drop maybe via email on Wednesday around that very point on how many, from pre-construction all the way through to construction and ramp up, how many of them are actually successful? And did equity have to bail out the debt that was in there? And if they had just been equity, would your returns be better all along? I'm just going to tease some ramp up and commissioning analysis, Matty. So
the big question is, to do that, you got to be able to get the equity.
Yep.
Hence why some go all debt because they can't even raise
100% right.
So
100% right.
Yes. No, that was bloody brilliant. Thanks Darko Fisty. Thanks James Marley and the Livewire team for having us. Well, it was a absolute ball terror.
It's good
of
fun,
a
hey,
holiday
matey?
over there.
Sure was.
It wasn't a holiday. It was fucking busy times. Yes, right. Thanks all the partners that bloody contributed towards the flights to get over there. VRIFY, AI is all you need to hear, and Silverstone. Never say never, never.
Who else we got, mate?
Bloody JD.
DSI, Underground.
Oh, mate, we have, and we've also got GetWet Solutions too. There's going to be some bladders up at Dalgaranga.
Brooks Airways.
Oh, mate, flying up to the Dalgaranga airstrip. CRE Insurance possibly ensuring that all of Spartan's work and every other mining company we talk about. WA Waterballs. Jeez, aren't they? They're bloody...
they're doing God's work.
They're getting some runs on the board at a few sites at the moment. Tell you what. And one site they've been on, the share price has gone up.
You better get in while you can now.
Yeah. If you want share price to go up, get James at WA Waterboards and K-Drill.
Hootaroo, money miners.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.